Good morning. Let's talk about something from the world of finance that might sound a bit complicated at first, but I promise we can break it down together. We're looking at an options strategy called the ratio put spread. Now, don't let the name put you off. Think of it like a carefully planned recipe. In this recipe, you are both buying and selling ingredients, or in this case, options contracts. Specifically, you buy a certain number of put options and then sell a larger number of put options at a lower price. It's this imbalance, this ratio, that gives the strategy its name and its unique character. It's a way to potentially profit from a stock's movement, but with a very specific view on how it will behave. The core idea is to create a position that can make money if the underlying stock price moves moderately downwards, stays still, or even goes up slightly. Imagine you're a market gardener. You might buy one expensive, high-quality seed for a prize-winning pumpkin, which is your long put option. To cover the cost of that special seed, you decide to sell 2 smaller, less expensive packets of regular pumpkin seeds to your neighbors. So what kind of market weather is best for this particular strategy? Are we hoping for sunshine and rising prices, which we call a bull market, or are we preparing for a downturn known as a bear market? The ratio put spread is best described as being for the cautiously bearish or even neutral investor. It's not for someone who is convinced the market is about to skyrocket, nor is it for someone who believes a stock is on the brink of a dramatic collapse. It is a strategy for those who anticipate a bit of a gentle slide downwards, or perhaps for the stock to simply stay put for a while. This is what tempers the bearish view and introduces a more neutral element. Now let's turn our attention to another important factor in the world of options: volatility. For this particular strategy, high implied volatility is generally your friend. When you set up a ratio put spread, you want to find a market environment where option premiums are relatively expensive. This works in your favor because you are a net seller of options. Because we are selling more than we are buying, we benefit when the price of those options is high. Think of it like selling insurance. If you are selling home insurance in an area known for its tranquil weather, you can't charge very high premiums. However, if you are selling insurance in an area prone to storms and floods, the perceived risk is much higher and you can charge significantly more. Every financial strategy has potential rewards and potential risks. The maximum profit you can make is well defined and occurs if the stock price falls perfectly to the strike price of the puts you sold. This is your best case outcome, a targeted strike that yields a handsome but capped return. Now for the risk, which we must always treat with the utmost respect. The real danger lies to the downside. If the stock price falls dramatically, far below the strike price of the puts you sold, your losses can start to mount very quickly. Imagine you're a safety net operator for a trapeze artist. You've set up one net, your long put, directly under the artist, but you've also promised to catch them if they fall further to the side, your 2 short puts. If they have a major accident and fly way off course, you are personally responsible for catching them. To make all of this theory a bit more concrete, let's use a real-world example. We'll look at a well-known stable company, Procter & Gamble, or P&G. Let's imagine that today, P&G stock is trading at exactly £150 per share. P&G, the maker of everything from Tide detergent to Pampers nappies, is often seen as a steady, reliable stock. Our view is that over the next month, P&G might drift down a little, perhaps due to some general market uncertainty, but we don't expect any disastrous news from the company itself. With this outlook, we decide to implement a 1-to-2 ratio put spread. First, we will buy one P&G put option with a strike price of £150. Let's say the premium for this option is £3 per share, costing us £300 total. Next, to finance this purchase, we will sell 2 P&G put options at a strike of £145. We'll collect £1.60 per share for each, totaling £320. We spent £300 but collected £320, giving us a net credit of £20. We've been paid to place our bet. This means we have opened our position for a net credit of £20. Now that we have our Procter & Gamble trade set up, let's walk through what could happen next. We can explore a few different scenarios to see how we would fare. The sweet spot. Let's imagine PG's stock price falls and lands exactly at £145 per share. The 2 puts we sold expire worthless, but our long put is worth £500. Our total profit is £520. This is our maximum possible profit. The danger zone. If P&G falls to £135, our loss would be £480. The losses can become substantial the further the stock falls, which is why this strategy requires careful risk management. Let's now go through the practical steps of actually putting this trade on. Navigate to your trading platform and bring up Procter & Gamble. Open the options chain for P&G and select the monthly options expiring September 19, 2025. Find the £150 strike put and buy 1 contract. Move to the £145 strike put and sell 2 contracts. The platform recognizes this as a 1:2 ratio put spread and calculates the net credit for the package. Double-check everything before confirming, then submit the order. The position appears in your account. You have entered the ratio put spread. Once your trade is live, you don't just forget about it until expiration. You can close any time before expiration. Many traders close early to lock profit or cut losses. The simplest way is to reverse the opening transaction. To close, sell the 1 put you own and buy back the 2 puts you sold. If you can close for a net debit less than your original credit, you lock in a profit. Is this right for you? It's a specialist tool for the thoughtful investor who's done their homework. Best suited for when you have a clear, moderate opinion on a stable stock, expecting slight decline or sideways movement in a high volatility environment, but take the risk profile very seriously. There is potential for large losses on the downside. Always proceed with caution, do your own research, and never risk more than you can afford to lose. If your analysis matches a neutral to mildly bearish forecast, this strategy is a powerful tool. Not a hurricane, not perfectly sunny, but light showers with a chance of clouds. Thanks for watching. Good luck with your trades and see you next time.